Clubhouse, WOR, New York Radio, and we are joined by Brett Owens, author of the book on dividend investing. But before we go to talk about dividends, Brett, describe your background and your origin story in the financial space.
Sure, Josh. Yeah, my initial kind of foray into the financial space, my first stock I ever bought was a dividend stock that never moved, that my dad loved back in the early 2000s, called National Fuel Gas. That was my initial drip. So I did a dividend reinvesting plan. The thing, again, never moved, but paid 4%. So dad loved it, and I got into it, kind of dripping back in. Started kind of trading on my own, doing that sort of sugar futures back in the oil boom days of the 2004, 2005, as Brazil was kind of converting their sugar into ethanol. So I was having fun there, and decided to start blogging on those trades and so on and so forth. And eventually found my way over to the income space, ran some newsletters over on the Agora financial side of things, and came over to a company called BNK Invest in 2015, and that's where we launched a service called Contrarian Income Report and Hidden Yields, and they're both focused on dividends, dividend growth type investing. And then our book, 2019, came out, who I co-authored with Tom Jacobs, on how to retire on dividends. So looking for high, meaningful dividends that'll generate yield for retirees, but then also not, excuse me as I knock over my microphone here, not blow up the portfolio. So keep that principal intact or better as the principal grinds higher.
There's dividend investing can be fraught with peril. Like, you know, you buy something that your Uncle Joe, or you said your dad, you buy that stock. I mean, there's so many that I've, seen over the years. You buy it for $10, pays a good dividend, 8%, and then it becomes $5. And I find that sometimes dividend investing is just fraught with peril. Talk first about the perils of dividend investing, and then how do you overcome that?
Yeah, it's a great point, Josh. So my basketball gym, where a bunch of us old guys playing rec league ball, is a saying: if someone's open, they get the ball and people run away from them, and they've got an open look. They're open for a reason. Yeah. So to your point, a lot of these dividend stocks, they pay high yields for a reason, because these things are kind of disasters or train wrecks. And we saw a lot of that last year, especially with rates going up. It wiped out a lot of the stuff that would float normally did not look good, where even if the dividend kept getting paid, you lost a lot of it in price. So yes, absolutely. The reason a lot of these things pay high yields is generally for a reason, because there's danger and it's recognized, and it's not necessarily that they pay a high dividend, it's that the price is low, and that's why the yield is high, which requires a bit of we call it a contrarian approach, or where you've got to find some reason where that perception is wrong, because it's paying a high yield because there is that perception of the danger. So it is fraught with perils, and you need to find situations in which the worries are overdone, if that makes sense.
So like banks right now, we'll get into all kinds of sectors. There's so many banks paying really good yields. You got, and we own some for clients. So all those disclosures, do your own homework. We're not telling you to buy or sell anything because we're talking about it. But, you have the big banks, the big boys, Citi, JP Morgan. Then you have the banks that sort of got caught up in the mess. So Schwab, which really isn't a bank per se, you got, although they have a bank, Schwab the banking crisis really hurt Schwab. But I don't know, I think they still have a really good business. Then you have like a Valley National Bank or a Truist. And then you have smaller banks, which one bank that I follow has a very similar name to First Republic. So it went from I want to say $3 a share to $1. And it doesn't look like that bank's going anywhere. And then you look and, Stephen Cohen is one of the lead investors. And so I don't think that's going anywhere. But how do you, just because banking's so beaten up and there's so much value there, do you like the banking sector Big banks. Let's do big banks first, and regional banks.
I'm not buying any of the banking stocks yet. I do like the big banks better than the small banks now, which is from a personal standpoint unfortunate because I enjoyed banking with the small regional banks. In my view, the challenge across the board, and I think your Schwab point is a good point. I think Schwab is kind of an exception where they got swept up in this, but they're not really a bank. So that's something it's a stock I've been keeping an eye on, and it's something we owned in our hidden yields portfolio back in a couple of years back. So I do like Schwab as that dividend growth story. What makes me nervous about the banks is that they're still paying in that 1-ish% rate on the deposits, and we all have the online banking apps, and we can move our money over to a money market fund that pays the 5%. So until that spread reduces, I worry from the fundamental standpoint that the deposits will keep leaving, if not the all-out panic that we saw in March, but that the trend is going to be for the deposits to go somewhere else in search of the higher yield. So it makes me the most nervous with the smaller banks. Obviously, I do think the big banks will ultimately be the beneficiary of it. So JP Morgan getting a good deal on the First Republic assets. So I do think kind of the big banks end up being the ultimate winner out of this. In my opinion, it's a little early to look at the banks themselves until that spread on the deposits normalizes, which means really until the Fed starts to cut rates and that begins to go the other way where there's less of a spread and risk of them losing their assets. But I do think there are opportunities there. You mentioned Schwab. Lincoln National is another one where they just paid another dividend and they've got this huge yield, 8-9%. They just paid another 45-cent dividend. And that's another one that kind of got swept up in the banking crisis. So looking at opportunities like that for now that are kind of tangential. And I think there'll be a time to buy the banks. And I think probably the big banks initially.
Yeah, but if it's not now, when? I mean, some of these are paying like 5.91 yields. They seem to have cut the losses. I mean, or you like buying things when it's on a clear uptrend, kind of the technicals. Do you look at technicals or no?
I do. Yeah, I do look at technicals. I like to see kind of before the uptrend, I like to see that divergence, right? The positive divergence where even if there's still kind of in that bottoming out process, you see like that downward momentum and the selling pressure has relieved. So I like to look at the long-term technicals for entry points as kind of the trigger. And I'm sure we use different metrics, you and I and stuff. So but that would be my cue on those is I would see the divergences that I'm looking for as an entry. And that's something I saw in Lincoln that I haven't yet seen from the major banks, although, I mean, I do think the big banks they were pretty washed out in March. I'm just not sure if that's the eventual bottom.
Yeah, no, I'm seeing it in Truist, May 4th down 26. Now it's up around 32, is stabilized. Valley. I don't like the super small banks. I like the bigger kind of regional that were somehow swept up. Like, I don't think, a Truist or a Valley or somebody. I think they're different than a very small bank. And a lot of the small banks have good balance sheets. So, again,
Truist bought our mortgage, so they're getting 0.25% from us every month for our auto pay. So they bought the mortgage service rights. So I'm with you there on Truist.
Yeah, it's like some of these are just really solid. And again, we own that for some clients. And I wouldn't say, I mean, folks, we're not even as a portfolio matter, I wouldn't have more than 10% of your portfolio in the financial space right now. And maybe even, 5 to 10 would be a good target just as a play because there's a lot of good value there. And if things don't go to hell, things are going to rock it up. So we talked about banking. I'm going to get all your sectors because this is fun. I love dividend payers. I'm sure a lot of our listeners love dividend payers to watch them. But I do find, like, how do you distinguish? I'm going back to the Peril question just because this is what you do at Contrarian Outlook. Like the banks, we know why they're paying a good dividend. That makes sense. People are just unnerved, like, will they? I think it's a great point you brought up of look for banks that are innovating that are giving their constituents the ability to get 4% on their money. So I think of like somebody told me Citizens now has like Citizens Access. So they're trying to like stop the hemorrhaging. Schwab, for example, yeah, they're giving you 0% on their sweep accounts, but you can buy a Schwab money market and get 4 to 5%. So I think they're distinct from general banks if they're innovators. So I like that point. Kind of look for the banks that are trying to keep assets, maybe giving away a better rate. But what other? But I want to go back to the Perils. Like I always think of like Pitney Bowes. You know, not that it's a great company, but you know, it's one of these dividend payers that kind of. It seems like it's always pricing that it's in a dying industry and it's kind of liquidating. Although, you know, hey, our small business use it, great product. Seems to have a niche that, you know, stamps.com kind of competed with and won, but they didn't give up and they're still going forward. And I don't know, my IT guy says they're better than stamps.com. So they I guess they're innovating. But how do you determine whether a company is paying that dividend because they're just in a dying business versus actually, I'm thinking, you know, Pitney Bowes or like an AT&T or, you know, where they're just paying a good yield, but it's like maybe you avoid that. And I'm not telling anyone buy or sell stocks, but, you know, I just have a hard time. I think a lot of people have a hard time distinguishing, okay, that's a 6% yield, but it's paying you 6 because it's maybe a dying company versus it's paying 6% because whatever, you know, it has a good business model.
Right. I think that's exactly what you need to be looking at. Is a great point where that's maybe the limitation. A lot of dividend investors is they see the headline yield 6%, 7% on AT&T, and then they make a buy or sell decision based on that yield where you have the underlying business underneath. So I guess a quick cheat sheet would be to look at the sales or the top line, because when the top line is shrinking quarter over quarter, year over year, and it's a dying business, that they're going to have real challenges supporting that dividend. So we had a subscriber write in asking about Hanes brand recently and purchased Hanes when it's kind of like a Pitney Bowes situation where it was paying an 8% dividend a few years back. That was since cut. And we did a post-mortem on a webcast about his Hanes purchase and potential flaws or stains, if you will, on the Hanes long thesis. And one problem that I had is I haven't bought a pair of Hanes since I don't know when. If you think back 5, 6, 7 years ago, there's a brand called Tommy John that owned every podcast. So a podcast like yours, everything was sponsored by Tommy John, and that's when e-commerce was taken off. So, I mean, what do people like myself do? You go online, Tommy John's, put your order in and you're good. And then when there's enough holes and my wife's throwing everything out again, I log into Tommy John again, I'm making my purchase. So my point is, like, Hanes is on the outside looking in, and who knows what their execs are doing, investing more into TV ads and nobody's watching, that type of thing. But you could also see that. So that was kind of the common sense approach. We're like, hey, is this 8% dividend really going to stay? When was the last time somebody's bought a pair of Hanes? But you could see it on the top line as well. The top line starts to go down first, and then boom, the dividend gets cut because they need cash. So if nothing else, take a look at that top line, because you can't really hide that top line growth. Now, a counterexample to that would be a company, ExxonMobil, where in 2020, remember, oil crashed, traded negative, right? Nobody thought that would happen. You go into 2021, and Exxon was taking on, they were not funding their dividend out of cash flow. They were taking on debt. So long-term debt was rising. So on the surface, that looked bad. Sales numbers were down because oil was down and long-term debt was heading up. But then if you take a sort of a second level approach to that and you see, well, okay, oil's down, but oil is on the way up because producers have cut, which means Exxon should be able to muddle through with this dividend. And the inflection point with Exxon was as soon as they began to pay the debt down, you saw that, you say, okay, if they're now able to pay down debt, the dividend should be okay because they've held it until now. And then that's going to be a catalyst because Exxon, you probably remember, was paying over 6% at the time in spring of 2021. So that was a clue in which sales were down, but it was because of a catalyst that was going to reverse against something like Haynes or Pitney Bowes, where you have to think about the business model, whether they're actually out of business. In Exxon's case, they were going to be okay as long as the price of oil rebounded, and that's eventually what happened.
Yeah, and I want your take on oil and gas when we come back. This is Josh Jelinski, the financial quarterback, and we're with Brett Owens talking about how to retire on dividends. His book, How to Earn 8% and Leave Your Principal Intact. He is the investment strategist, chief investment strategist for Contrarian Outlook. You can find his work on contrarianoutlook.com. And call us today on 888-988-JOSH for his book, and I'll give you his book for free when you schedule and keep your no obligation second opinion on your money. 888-988-JOSH, 888-988-5674. We'll be back after these messages. And we're back. This is Josh Jelinski. Call us now, 888-988-JOSH, for our giveaway, which is How to Retire on Dividends. His book, Earn a Safe 8%, Leave Your Principal Intact. I don't like saying safe anything, though, but we'll talk about that. But I guess what you mean is more of a stable income. But that's the dream, I guess, right? To have that $1 million portfolio, get 80 grand a year, and have it stay intact. So we're with really a very knowledgeable guy on dividend investing. So we're talking about HBI versus Tommy John. You know, it's funny. I bought the Bombas, undershirts. You know what they are? Bombas. They're like a new Hanes, I guess, or Tommy John. I avoided Tommy John because I particularly found their ads for underwear offensive, like their internet ads. Where Bombas, I don't know, they made it feel like, oh, it's nice and soft. But it's funny. Bombas seemed... If I was the Hanes should hire me back as their spokesperson. My point, my sales for them would be, we feel like Bombas or Tommy John, but we're half the price. Because, how much more comfortable are you going to make that soft cotton going to be? Or, I will tell you, Bombas I bought them because I wanted really high quality undershirts that felt nice. And it had like some Black Friday deal. And they're very soft. Feels like, I'm wearing... very, very nice. Just a thin layer of gabardine. But it's exceptionally comfortable. But I will tell you what I don't like about it. They're wearing no better than Hanes. The neck's getting all stressed out. Then I went and got this, I don't know, James Dean wore this company. I got them. But I'm trying all these internet undershirt companies. Is there one that you like better than another?
I'm in the market, Josh. I'm with you. Actually, I'll check out. Well, I guess I'll follow your lead here. Yeah, because my Tommy John undershirts they're in disarray.
Yeah, but I thought, but that's my point. It's like you're going away from Hanes, but I might go back to Hanes because maybe they're half the price and they do the same work, and I just get a fresh pair every so often. There's nothing like a fresh undershirt, no.
They lost us because they didn't sponsor podcasts like yours.
Yeah, exactly. So
all they needed to do was stay on the marketing edge. The product was fine.
Yeah, I feel like because Bombas, what was nice is that it's a very nice initial feel, but I feel like they're not wearing well. I will tell you, Bombas feels great. There was this company I bought, James Dean. Like it was like the literal company of like 60 years ago that the T-shirt, and they rebranded it, and they're pretty cool because you could wear them like as regular T-shirts, very comfortable. But I don't know. I would say Bombas is way better than Tommy John, just kind of initially, and Bombas was better than Calvin Klein, like the Costco Calvin Klein, or the Macy's Calvin Klein, where it feels like you're wearing like Spanx, it's all tight on you, I felt like Bombas was great. So we'll see, but I'm not happy with how they're wearing. I bought them around Black Friday. So eight months, I found like my Hanes or my Calvin Kleins lasted longer. So anyway, but that's a good point though. look at the sales. What are the metrics you're looking at to see? Are you looking at, price to sales? What metrics would you look at?
Well, I think talking through it's enough. So think about us and our undershirts, right? We're free agents. We're on roller skates. That next order, if you tell me, hey, Brett, you got an order from Bombas, I'll do it, right? So that's, I think, where the world has changed versus the Peter Lynch days of 30 years ago, where you could find that brand and right, Warren Buffett traditionally fond of that, where you find that brand and they're going to have the cash flow and the sales are going to be there and they're going to keep paying the dividend. Now you've got a couple of choices to make. You still have those blue chips that everyone knows are that dividend's going to stay, but they're typically paying 2, 3-ish, 4%. So if we're trying to get the 8% that we're talking about here, we almost need to find industries that are washed out, but washed out for no reason, which is one reason we were talking about oil, right? Natural gas right now, natural gas is trading around just above $2, which is the cost of production. So we know this is a rough floor for natural gas long term, where if we add to some natural gas stocks, especially pipelines that are paying a large dividend now, we can reason we're most likely getting a good price, right? Because of that underlying commodity being at a floor versus at a ceiling. March of last year, right, when Russia goes into Ukraine and oil spikes, that's when things are a little toppy. Now it's the opposite, especially on the natural gas side of things. So when we're again looking for these dividend payers, we either want sort of that sustainable type of business, which is getting harder and harder to find in 2023, given just how fast businesses get disrupted and their business models get disrupted. Or the other alternative is to just look for an industry that's washed out, right, and ready to either bottom or a minimum just not go down anymore, which is kind of what we're looking for as dividend investors.
So what industries, you mentioned natural gas, what natural gas type companies do you like?
Williams is my favorite. They're the biggest, largest pipeline provider, kind of a toll bridge in the U.S. WMB is the ticker, paying, I'll look it up now, but paying roughly 5-ish% as I talk. So Williams, I think, is a pretty good entry point on that one. Get you the exact yield here. Yeah, 5.9% today on Williams. So you will see Williams between 5, 6, 7%. It's structured as a corporation also, so you don't end up with the messy tax form with the K-1. So a nice benefit there. Enbridge is nice also. Canadian company, pipeline, paying roughly 7%. There's AMLP, Illyrian, which is a fund that aggregates several of the pipeline companies, 8.9% today on Illyrium. Kinder Morgan, KMI, 6.7%. And they're also, Kinder flipped over to a corporation a few years back. So it helps you out from the tax standpoint as well. So long term, I like all these guys. I was saying long term, I think the rest of the decade is going to be sort of that energy bull market, energy supply constraint. We're going to keep hearing about that. Short term, who knows? We have had these recession fears hanging over us for almost a year now, it feels like. Head into recession, energy demand goes down. So you could see pullbacks on all of these names. But if we look out 5, 6, 7 years, it's my opinion, this is where you want to be.
So what about people say, well, Biden's president, if he wins re-election next year, they're going to do all these solar things and gas and coal and oil and all these, things that they say are dirty, even though, in one sense, natural gas is probably better for the environment than, batteries leaching into the soil and taking all of our lithium. But what about people say, there's a political risk with all these companies?
There is a risk. I think it's longer term than people give it credit for. I mean, I think even if all the quote unquote green technologies hit, you're still 10 to 15 years out before they can make a meaningful dent into fossil fuel. So you still got to get from here to there. What also gets lost is all this transition to green technology takes a lot of current energy, which is fossil fuel based. So you got to burn a lot of oil and potentially natural gas to make the conversion. You got to build a lot of stuff, a lot of new infrastructure So you're still 10 to 15 years out.
And would you distinguish the gas companies that you mentioned from like the Exxons, the Chevrons, the BPs of the world?
I would. They roughly are going to trade similarly, right? Energy complex, but I would differentiate them into slightly kind of different buckets, different drivers, right? Because you've got the Exxons, the Chevrons that are the producers, and in those cases, probably want to buy. You're more looking at the price of crude oil. When crude dips, kind of as it is around now, around a support levels, longer term floor. That's when you think about adding the Exxons, the Chevrons, right? The other guys, the Williamses, the Enbridges, you look at natural gas. So you look for natural gas around the floor to be adding money to them. So you don't necessarily want to buy them or add too much when natural gas is at $9, when it's at $2. That's a good time to purchase those guys.
How do you reconcile, like, if crude oil is at a low right now, you're saying? Well, what's price of crude
believe
right now?
so.
Okay.
Yeah, I believe so. And I think that's just, to your point on technicals, I think it's just a matter of looking at the chart. You've got support in the high 60s, 70s. From a fundamental standpoint, we're still drawing down the strategic petroleum reserve, and that was supposed to, in theory, going to be restocked at some point. But you're still, again, drawing down. So there's still that artificial supply on the market that can't go on forever. So yes, I think aside from like a deep recession, which you can't necessarily rule out, but aside from that scenario, oil is pretty good buy here.
No, I would agree with oil, but it's interesting because Exxon's pretty high on its 52-week range. The low's around what? 80s, highs around 118. It's about 105, kind of the higher midpoint of the range. So you're pretty bullish on kind of the gas petroleum complex.
More the gas, yeah. Exxon not as I think it's a little. I agree with you. It's a little high here.
Okay.
We closed out in Contrarian Income Report. We did close out our Exxon position in the late last year, just for that reason. And it felt like it had gotten a little bit
toppy
ahead of itself. And I think the same with Chevron.
Yeah, if you
like
look,
to buy those
you kind of
guys
see it. Yeah,
more washed out.
BP's on the higher end of the range. Chevron. I mean, these are great long-term companies to have. So you would say don't worry about the gas companies because generally, your worry might be 10, 15 years out. Because it was interesting, a couple of years ago, people just gave up on all those stocks. After 2020, I mean, what was it, like 30? They went down like 50% during COVID. And people just vomited them out of their portfolios because they were scared.
A company, One Oak is one we followed, and we're fortunate to buy in April 2020, and I got the entry here. So currently it's a $60, $58 stock. You got it for $30 in April 2020. It was paying 13%, 13.2% yield. It was nuts, and that was off of its late 19 highs were around $70, $75, and it was featured on CNBC. Hey, it's going to hit 80 for One Oak, and it went the other way. It went to 30. Now, kind of a rare opportunity there, right? But those things just got so washed out that everyone was worried about a dividend cut for One Oak, and didn't necessarily have a way to rule it out. It said, hey, the thing pays 13%, even a 20% dividend cut, you're still getting a 10% yield. And as long as the world economy kind of stumbles back on its feet in some respect, it's got enough assets to
what opportunities are out there? Well, actually, this will be a great time to take a break. We will be back after these messages with Brett Owens talking about dividend investing, and we are mentioning stocks. We may own some of them for various in our portfolio, but we are not recommending you buy or sell any stocks based on what we say over the airwaves. We're just giving you kind of ideas to kind of elucidate principles based on some of these stocks. Do not buy stocks without doing your homework, consulting with your tax, financial, legal, accounting people. But it's important that you get this book, great book by Brett Owens on dividend investing. What's the title, Brett? The title is How to Retire on Dividends, Earn a Safe 8%, Leave Your Principal Intact. And always remember, investing involves risk. So call us 888-988-JOSH, 888-988-5674, and I'll give you the book for free. Or you can go to contrarianoutlook.com or howtoretireondividends.com. And folks, if you have a question, feel free to type it in the chat box. Raise your hand. We're on Clubhouse right now, the social audio app, WOR 710 AM, New York's big AM talk radio station every Saturday and Sunday at 9. Hit the subscribe button on YouTube and call us during the break, 888-988-JOSH for the free book, 888-988-JOSH. We'll be back after these messages. And we're back. This is Josh Jelinski, the financial quarterback, with Brett Owens, talking about how to retire on dividends. And, what opportunities do you see that remind you of March 2020, April 2020? I was thinking maybe banking, financial complex, because of the, everyone's kind of fearful of that, like they were fearful of oil and gas in April of 2020. Any other opportunities you think people might want to look at, although you've said, hey, kind of want to wait to see how the banking thing plays out, you wouldn't go headlong yet. What other opportunities do you think are available, maybe values?
Bonds are looking really attractive right now. Last year was a terrible year for bonds, right? So long-dated treasuries. So if we look at the TLT ETF, it was down 31% calendar year 2022. So you think of a safe and that was, by the way, the trade that kind of washed out Silicon Valley Bank, right? Because they put their money into treasuries, and then even though they didn't sell them, they were $20 billion in the hole because of that paper loss. So people buy treasuries and they don't think of the potential for price loss, but that's what happened in 2022 due to the interest rate move. Now, the good news then is that you had that washout, and the long rate, if we define maybe the 10-year rate as our benchmark here for our inverse bond metric, right? The 10-year topped out late last year, October, 4.3%. Went all the way down for a little bit there in the 3.2s, and now we're back up in the sort of middle to higher end of what I think is its current range. And I think when you're in the higher end of a current range and yields, you want to be buying bonds, especially with that recession kind of looming over us, right? And that potential where, hey, if we hit a recession, rates are going to go down, people are going to flock to treasuries and other safe yields. So one idea, actually one favorite idea, muni bonds are really cheap right now. They're closed-end funds trading at 14, 15% discounts. The yields are nice. So if I look at Nuveen Municipal Credit Income Fund, so NZF is the ticker, the headline yield is 4.5% today, but that is federal tax advantage. So that yield, depending on your bracket, can be up north of 7% from a tax advantage standpoint. And again, you're paying 85, 86 cents on the dollar for some high quality munis. Nuveen's getting the first phone call here. So this is an example where if you look at a muni ETF, it might be a good purchase, but a closed-end fund is going to have the extra advantage where they have a fixed pool of shares, so their prices don't always act rationally. They can trade at discounts or they can trade at premiums to their NAVs. And I've never figured out the exact reason. I think it's just because there's less capital there, so they're not as efficient as large liquid ETFs. Large funds have a hard time getting into CEFs, so it's a lot of individual investors. And how do individual investors feel right now where they're generally scared, which presents opportunities. So you can have these closed-end funds, and a lot of these muni closed-end funds are about as cheap as you'll ever see them, trading at 14, 15% discounts. Meanwhile, munis are set up to do pretty well. Sure, it depends on the municipality, but you can either buy these funds that get you the federal tax advantage, or Nuveen even has these state-specific funds. So if you're in a high-tax state like New York, California, you can even get out of your state taxes if you buy that state-specific fund.
Yeah, because buying individual munis right now, you're not going to get, I don't know, I looked, it was like 2.9 is what you're going to get, 2.5, 3. Where, yeah, you look at these yields on tax-free munis, you get like 4.84, you got Invesco insured municipals, another one. There's a bunch of them that Nuveen's a good company. That we're not recommending you buy or sell these, but yeah, I mean, just look for closed-end funds that specialize in municipal bonds. How do you decipher, though? Some of them do have like leverage a little bit. That's what I've noticed of why they sometimes trade at such a steep discount. So the fear of interest rate rising, I know that really battered IIM was one of them. But it seems, there was a whole hedge fund. I want to say its name. For years, some of my like super wealthy client, guys worth like $100 million, like I'm investing in flippity bip hedge fund. And what they were doing, there was a trade, they were like loaning money out at X% to buy munis. And they were doing this for very wealthy people. I said, it's a nice idea, but what if interest rates go up? That trade's going to get just destroyed. And it did, but now it's probably not a bad buy to buy them again. And it's funny, I'm looking at one. It is trading at the same value or close to the '08 value. Some of these insured municipals funds. But again, they're not without, people got to realize when you buy a municipal bond fund, your share price will fluctuate. So you could lose money if you go to sell it. Sometimes people get confused by that. You're not buying the actual bond. But in October, you're right. I mean, I was telling everybody, man, the 10-year Treasury, very few people took me up on the 10-year Treasury recommendation in October of 2022. But that was a great trade. Because my thought was just common sense. Because I help a lot of retirees who call our office at 888-988-JOSH. And I'd have so many people that go, Josh, I have $1 million invested. If I could just make 4% on my money for the next 10 years, guaranteed, I'm fine. And like that was the time. You can still get great yields now. 5.2%. We just bought somebody, I don't know, 1 year, Treasury 5.2%. You still get really good yields right now buying the individual bonds. And hey, if rates go down, your 10-year bond's going to appreciate in value. You can sell it for a profit in a few years. So I think, looking at treasuries is a great idea if you're more risk averse. Looking at these municipal bond funds, another great idea. And when we return, we'll get more great ideas from Brett Owens, who, man, this is a fun interview. I never interviewed you before. The book is called How to Retire on Dividends, Earn a Safe 8% and Leave Your Principal Intact. Always remember, investing involves the risk of loss of principal. But you get that book for free at 888-988-JOSH when you call us now. 888-988-JOSH. Check over his work at contrarianoutlook.com. When we return, I'm going to ask the contrarian man, what are some contrary trades he's thinking up of today and other opportunities to seize and risks to avoid. When we return, this is Josh Jelinski, the financial quarterback. Don't touch that dial. And we're back with Brett Owens, author of the book, How to Retire on Dividends. So, Brett, are there any other opportunities to seize that you see?
Yeah, Josh, you talked about that 10-year moment, right, last October, where that was the best time to buy bonds. Well, if that was the best time, this could be the second best time, right? So we've had the 10-year pop up again, which was to be expected, sort of a retracement here. And to your point on leverage, right, there was a great point where some of these Nuveen muni funds, they do use 40+% leverage. So last October was not necessarily the best time to buy them because even though the long rate, the 10-year had peaked, their cost of money was still increasing, right, with the Fed hiking still. Now that we're at the point where if the Fed is not close to being done, they are within a quarter point of being done. So the cost of money for these levered funds it's at least peaked or it's close to have peaked. So that opens up the opportunity not only in munis, but shall we say for our more enterprising, less risk averse listeners here, you can consider some closed-end funds from PIMCO. We all know PIMCO, right? The Bill Gross shop, now run by Dan the Beast Iveson in his wake, and some of these PIMCO funds have similarly been washed out, and they continued lower after the October peak in rates. And again, the reason is because short-term rates continue to increase in these funds, use leverage, but their yields are nuts, to use a technical term. So we've got the PIMCO Dynamic Income Fund I'll toss out there, 14.5% it's currently paying. And again, this is a responsible PIMCO fund that really does great during most times. It does give you the cardiac events when what hits the fan, like April, March 2020, as individual investors pull back. And then it was absolutely crushed last year in 2022 as the interest rates rose. But in my opinion, this is a good time to start stepping into that one. Sister fund PDO is another good one, 11.8%. And you can get PDO at a little bit of a discount to its NAV. These PIMCO funds people usually chase. So you often see them at premiums to their NAVs. You can see them at steep premiums. I mean, sometimes during bull markets, 30, 40, 50% premiums, which I wouldn't recommend doing. But again, investors usually see these headline yields, which are huge, and they pile into these PIMCO funds. And the only reason that they're so, quote unquote, cheap now by their historical standards, again, is kind of that broader fear and the fact that these funds have just gone down for 18 straight months. But to your point about reasoning, and if we're thinking through this, with the cost of money peaking out now, and if we're right about interest rates in the 10-year being at a higher watermark rather than low, these are good times to buy these funds, because you could, not only are you locking in these yields, but you could get some potential price appreciation also as you go here, as the NAVs increase.
Yeah, and mind your position sizing. I mean, people, you don't have to put all your eggs in one basket. I mean, make sure you don't have any more than a couple percent in any one of these securities, Now, as we're talking about other opportunities, what else are you seeing in the world?
Yeah, let's go bond. Well, we're talking bonds, so we've got bond proxies, right? Stocks that act like bonds, which are things like utilities. So we've got decent level. If we're right about the 10-year rate being high, then utilities should get a bid. And that's also attractive as you head into a recession and you kind of get that flight to safety. I like the growth, what I call the growth utilities, the best. So Next Era Energy is a utility I follow. They're out of Florida and they do a lot of the renewable stuff. So again, if you're thinking political themes here, Next Era is usually the fastest dividend raiser, where you're not necessarily getting that huge current yield, but you're getting a raise as you go. I actually like their spinoff. It's an old yield co they spun off back in 2015 called Next Era Energy Partners, NEP. And with NEP, you're getting a very high, you're getting a 5+% current yield. What Next Era did is they spun off all their renewable projects into this yield co. They're not going to give you a K1 either. It's got a corporate status, so you get a 1099 at the end of the year. But with NEP, you get a 5% yield, but the dividend growth is huge. Their CFO, Kirk, I'm blanking on Kirk's last name. I always refer to him by first name in our pros, but Kirk always reiterates that they're growing the dividend 12 to 15% per year, and he's since reaffirmed through 2026 that you're going to get 12 to 15% dividend growth. So something like NEP, if you're looking at a stock that should grow with its dividend, I don't think the yield's going to go much higher. So you're looking at double-digit price growth that should go along with those dividend raises, and then a 5+% yield today. I mean, that's pretty good in my book.
What do you think of the telecom kind of complex? Verizon's paying a really good dividend yield. I don't see Verizon going out of business, but by the way it's pricing, I guess Wall Street thinks it's done. It's almost being priced like it's AT&T the last 5 years. But I know in the Northeast they pretty much still have a monopoly. I mean, I went, a lot of people have tried, T-Mobile up here, and I don't know. I found that T-Mobile stinks where I live. So, a lot of people going back to Verizon. Then they have Fios. I mean, AT&T doesn't seem like it'll ever recover. But what about the whole telecom world?
Yeah, interesting. I was actually on the point of AT&T. I was looking at that for our trading service, and we didn't pull the trigger on it yet. But that stock, from a technical standpoint, we were talking earlier, does look bottomy to me, at least from a short-term standpoint. So I think there could be some opportunity there. Out here in California, it's not a monopoly, it's still a duopoly. So I still have Verizon. for my cell service here. I went to the Verizon store to get my new phone a couple of months back. They tried to send me home with a box for internet. It was kind of a disaster. They weren't ready for prime time yet on that front, but still player out here in terms of cell phone service. So yeah, I think the telecoms, I think are fine. I think the sell-off is probably, at least from a short-term standpoint, probably overdone.
What's the point of the
backdoor play that I really like are the cell phone tower plays. So like the Crown Castle's my favorite right now there. So they own the cell phone towers. They're a real estate investment trust, and they're kind of sort of lease out the towers to these guys. And it's an expensive business to start, but once they have the towers, they just kind of bolt on the extra equipment. So we're looking at the CCI, the SBA Communications, and then American Tower AMT is the other cell phone landlord. All three actually look pretty cheap at this point to me.
What about music royalties? A few years ago, that was a great buy. I think now that kind of story, which was hidden, is kind of discovered by a lot of companies. But do you see any opportunity there anymore or not really?
You have any individual stocks you watch there, Josh? I haven't seen.
It was a really good play years ago. It was like the greatest. Mm-hmm. It was like Mills Music Trust and stuff, I think. Was it called? I'll have to look at. I wasn't really prepared on the music trust, but basically they bought the royalties. Mills Music Trust was one, and it's thinly traded. It's kind of on the pink sheets, but 2018 when I was first turned on to it, it was like $22 a share. Pays a 7.38 dividend even now.
Wow.
And it owns the American standards of yesteryear, and with some of the court cases that enabled the old time music, which was not protected after so many years. They bought up large swaths of catalog of music, but I didn't know if you still think, hey, it's going to sustain itself. But I'm not really. That's the only one I really follow, EMI Mills Music. But
yeah, I haven't. It's interesting. I haven't followed it. I will say when considering things like that, even if we think there's a time limit to when their royalties may end, it's interesting to look at the potential payback you might be able to get. Like, hey, can it hang on for 5, 6, 7 years where you're getting a third or half back in your dividend? It kind of lowers your risk in that. And we'll see that from the closed-end funds we talk about, where we've got these huge yields and you get your costs, your initial cost, you start recouping your initial cost back so fast that it does reduce your risk pretty quickly as you're just collecting these dividends.
Yeah, I mean, and they own a lot of the songs that, McCartney, Paul McCartney got into it. Now, a lot of rich people, a lot of these musicians, they're just buying other people's music catalogs. But Mills was one of the first that kind of did it for EMI and some of those rights. And I think, Paul McCartney bought a bunch. Michael Jackson bought the old Beatles. Bruce Springsteen bought some, but I didn't know if there were any others that kind of an interesting concept. There were a couple other ones some people are saying online, but, we'll save that for another day. But it's interesting, kind of, who would have thought, buying up oldies would have been a good investment 5 years ago. But it makes perfect sense now. But I only was turned on to it by a listener who worked with the Temptations. And his house, this guy's amazing. He has like a Graceland. His house looks like Graceland. And he knew Elvis, was very involved in the old kind of music scene. And he loves kind of stuff like that. But it's interesting to see that, who owns these things. And what a lot of these people did is, especially like Motown groups and stuff, and 50s, 60s, before it got big, a lot of them sold their rights away prematurely to catalogs and got significantly screwed for years to come. So I was like talking to people because you get different ideas and, what about that? What other opportunities to seize or risks to avoid right now in the dividend world as we conclude?
Well, one thing I'm watching, and I wouldn't do it yet, but we did write about this last week, and we get a lot of emails about some of these covered call funds, both CEFs and ETFs, and the idea with these guys is they'll buy the index, so they'll buy S&P 500 or the NASDAQ, and then they'll write covered calls either on the index itself, or it's better if they do the individual stocks because they get better premiums. There's two ETFs that I'll mention, and let me just say I don't think they're fully baked yet from a buying standpoint. These guys you want to kind of buy, think like October last year, right after a washout. But they do pay these big headline yields. They're JP Morgan funds. They've got a JP Morgan NASDAQ equity premium ETF that pays 12.5%. So they're doing calls on the NASDAQ. And then they've got JEPI, which is more regular equities, 9.4%. Now on their site, they say that they're timing the market and they're rotating sectors and all this. And it's like, okay, well, that's all well and good. But generally what you want to do is after washouts, easier said than done. But when nobody wants to buy these things, that's when it's great to be able to get in because you kind of get that price floor locked in with them. You don't necessarily want to buy them now when the market may be toppy.
Yeah, and they're
at least
hot
in my opinion,
because
it is.
Barron's mentioned these. A lot of these things, too, that we're talking about, you don't really want to buy because you want to be very careful. I always say this, do your own homework. Get a financial advisor or read Contrarian Outlook or one of these things because, like, when you hear it, by the time you hear it on YouTube, like, it's probably too late. And you want to be knowledgeable so when they are at a discount, that's when you pounce, because then you'll kind of follow the trend. Yeah, I've seen them. My only risk with these is I'm going to, they started like last year, so I worry about these. Like
Right.
I'm talking about with like client funds, like the insured municipal space or those closed-end munis. We've been through two really colossally bad times to buy munis. One, I don't know if you were around them, but the Meredith Whitney did a 60-minute special.
Yeah,
and
2007, 8, was it?
It was 10.
Yeah, 10,
2010,
yeah.
2011. And
after.
And the bond funds just collapsed. Like, I don't know, it was just like all these people, older people who owned these funds at the time, who were sold to it by, let's say, their broker at XYZ Wirehouse, and they just sold everyone. Because I remember I was getting calls left and right. So it's still when people watch 60 Minutes or whatever. And then now they're not really as relevant culturally. 08, obviously the 08 financial crisis, COVID, there was sometimes, but it's amazing how, those have a track record of 20 years. So you can kind of see what happened. My worry with these covered call ETFs is, although very attractive yields, we've not been through a period where they've blown up. We don't really know, like, what is the risk. It's like that, I don't know. There was some Allianz PIMCO fund that kind of blew up a year or two ago in COVID, and there was all these issues. And nothing against them as a company, a fine company, but there was a trade that they were making, and it was kind of like that. And then it kind of blew up. And, then the risk is in the prospectus, but nobody really knew exactly that was the risk. And so I tend to like buying the individual bond, the individual stock. But a lot of these ETFs are cool because if you're not an expert in writing covered calls, they do give you that ability to write covered calls without being an expert. And frankly, most financial advisors are not experts in writing covered calls. So it's probably better you buy an ETF that has covered call exposure. So I like the idea. I just don't know how, you know what I'm saying? Like,
oh yeah, no, I hear you. I was on their website as I was writing the column, trying to figure out exactly what their positions were, and I wasn't able to do it at a glance, which wasn't a great. I saw what stocks they owned, but it was a little sketchy in terms of the call portion. It was, we used some synthetic notes, and I didn't know what kind of backdoor stuff they were doing on the JP Morgan side.
It's just strange, and it's like that. It's like the muni bond funds you talk about. Well, we know there's some fact of leverage, right? So the risk is going to be if rates go higher than we think, because we're sort of, I guess, betting on rates going down, kind of both agree on that, it seems, slightly, or, we kind of maybe the terminal point sometime this year, and then we'll kind of subside, go back to reality, but if we're wrong and rates start going up again, it could go lower, and I'm assuming by what you're saying, you think rates are going to go down. Is that correct?
I do. Yes. Yes, I do.
And
yeah, I think the short term, like we were saying, which is the cost of money, the leverage cost component, I think it's about near a top, right? And then the Fed will cut when they really break something. I think they've probably already broken something, but when they really realize they've broken something, and then yes, I'm with you on the 10-year where I think it's at the higher portion of its current range, and we're heading. We hit a recession, or it's going to head lower.
Well, I want to thank you for joining us, Brett Owens, author of the book How to Retire on Dividends. Great title. How to Retire on Dividends. Call us 888-988-JOSH. 888-988-5674. You can go to contrarianoutlook.com. Is that the website you want people to go to, or How to Retire on Dividends?
Yeah, that's great. Yeah, contrarianoutlook.com, Josh. Thanks for the plug. And we publish there every day. So Dividend Ideas, it's a free resource. You can get signed up for our free newsletter. You'll see the premium link as well. But daily, we're always spitballing ideas, and just kind of like we were today, Josh, like, hey, whether we like something, we don't, but if it's got a yield, we'll talk about it on contrarianoutlook.com.
Want to thank you to all who joined us on Clubhouse, YouTube, also WOR Radio. Make sure you subscribe to us on YouTube, Spotify, Apple Podcasts, iHeartRadio. Thank you so much, Brett, for joining us. And folks, if you like what you're hearing, get his book, How to Retire on Dividends, free, 888-988-JOSH, 888-988-5674. I want to thank you all for listening. Thanks, Brett.
Yeah, thanks, Josh. That was fun.
Awesome. Take care.
Cool. Thanks. You
Bye.
too.